Another day in paradise. Can't make this stuff up. I think probably end of September can't come too quickly. Can't come fast enough. Ay, ay, ay. Just when I thought we'd done enough spaces, you guys pull me back in here, or Mr. Market does anyway. It's just, I can't say what's happening is really a surprise. This is ultimately going to happen sooner or later. What we saw the other day on Wednesday, was it yesterday? Seems like it was a long time ago. Was that a bottom? Yes. Trigger alert, bad joke coming. Was it the bottom? Nope. I have to mention, as a side, I'm sure you're all aware, today, Nope started trading. So we can talk about that later. We'll see how that plays out. So Nope, in its debut, traded 65,000 shares. You will see the holdings, as it's a fully transparent ARC. I'm trying to be just like Kathy. You're going to see the holdings every night, so you'll see them up there. Really interesting. What's a lot of moving parts here. What's different? The decline doesn't stop. It's just relentless. But I was reading off of Zero Hedge, and I'm quoting from an article here. They said, the crash just won't stop, but today something's changed. After yesterday's euphoric BOE-inspired short squeeze melt-up, today was supposed to be a continuation rally, courtesy of one of the most oversold markets in history. Let's go back to the weekend. I mean, over the weekend, all those that graph of the put volume, most puts traded ever, that was making the rounds. Everyone was appointed to McClellan oscillator and one thing after another. Say, oh, it's going to rally, it's going to rally. And I sat there and I said to myself, you know what, George, don't be a jerk and short in the hole. That's stupid to be playing against the odds. But then the other side of me said, everyone's talking about that it's oversold. Everyone's saying it's supposed to rally. And I forget who coined the phrase, but when the market doesn't do what everyone's expecting the market to do something, it's something else which inevitably happens. And that's where we are. So in any event, the BOE with what they did, reversing their QT to QE just within a week, that was supposed to give markets a respite. That didn't last very long. Yields came off a bit. The dollar has actually, declined a bit, but that hasn't saved equities. As the great Michael Howell always says, volatility starts in the fixed income markets, then goes to the currency markets, and lastly winds up in the equity markets. And that's kind of where we are. And for those of you paying attention to FinTwit, it's all types of speculation, who's been selling. We had the disaster in the UK with the pension funds and stories that maybe the SMB is selling. Who the heck knows? But what is true, I saw a blurb the other day. I'll find it as we get into this room. I saw something the other day which spoke about following the Fed's decision last Wednesday that retail selling actually picked up in earnest. And that's something we hadn't really seen very much this year. And so that's different. So as for those of you that remember Laurel and Hardy, gee, Ollie, this is a fine mess you've gotten us into. This is when things start to possibly become disorderly. If retail's given up the ghost, and you might think that evidenced by the poor price action in Apple and Tesla, most notably, the last of the Mohicans, maybe they are. And I kind of, my own roadmap, and what do I know? Just me trash talking. Yeah, we'll get a bounce. Maybe that was it. But when the market doesn't bounce when it's supposed to bounce, or when the bounce is pitiful, there's information content in that. When the market doesn't do what it's supposed to do, when it's supposed to do it, you got to stand back and say, what? So I know people always say I'm too bearish. I don't think I'm always too bearish. I've been bearish this year. And yeah, I'm probably on balance. My personality is such, I tend to be glass half empty. I'll plead guilty to that. But I'm really trying to be a realist. And I could easily see a scenario where We get in the fourth quarter. Yeah, all right, fine. The market's up last day of the quarter, first couple of days of next week, whatever. It's all noise. I don't really care. But in trying to get the big picture right, we've nailed it this year. I could see a scenario where, the economic news continues to get worse. We're going to go into earnings season now. And Thornton, I couldn't remember the other day. You weren't in the room, but I wanted to use the term FedEx, and then someone after the fact, I said some guy coined the term FedEx, and some guy after the fact sent me a DM saying, "Yeah, that was Thornton." You're going to see an increase. And so, Tommy, you got to patent, you got to copyright that. At any rate, I think you're going to see an increasing number of companies get FedExed. They absolutely, positively can't deliver the earnings, and they're going to get FedExed. Ooh, that was a bad joke. So I think you're going to see increasing earnings disappointments. Stocks, I know this is hard to believe, but stocks, and I was just having this conversation with somebody before the room started, stocks have not fully adjusted for the increase we've seen in rates. Stocks are more overpriced now compared to bonds than they were in January. Or put another way, the equity risk premium needs to go up considerably. So you combine that, and we'll have Kayfabe weigh in on this, I'm sure, because he's better with the numbers than I am. I don't think you're getting any real material relief on rates. If you do, it's for the wrong reasons, because the economy's falling apart. So stocks still haven't caught up with bonds in terms of multiple compression. You combine that with falling earnings estimates, and earnings have only just started to fall. The chart I saw the other day showed estimates, I think, I can't remember if it was the third quarter for the year. It was the third quarter, maybe, down 6.3% over the last 2 or 3 months. And so earnings are starting to fall at an accelerated pace. And before people say Michael Belkin is crazy, Michael Belkin's not crazy. Michael Belkin so eloquently pointed out in this room the other day that the last 3 downturns, earnings declines have averaged, I think it was 50%, 50. So whether or not earnings get to $111 a share in the S&P, who knows? But the street's smoking something because they're still running with 230 numbers. So let's split the difference and call it 170. Just to start the conversation, let's take 170 times 15 or 2550. All right, I'm in a good mood, we'll make it 3,000. I'm in a bad mood, we'll make it 2,000. Whatever. It's all downside. I mean, there's just no upside to this market, period. So you don't have to be a degenerate crazy and go short. That's fine. Leave it to the professionals. But for God's sakes, I keep coming back to what I've said every single room. Equities represent return-free risk. Get to cash. At least you'll sleep better. Now you're getting paid 4%. Okay, enough of that. Today's room was hastily arranged. Tommy and I decided at 3 o'clock to do this. And we've got Tom Thornton is going to opine on what he sees happening. And then I'd like Dave Nicoski and then Kayfabe after Tommy weighs in. Tommy, I love you, man. I love your flexibility. You're not half glass empty like I am, so it's always good to hear some sunshine and hope from you. But I think even your hopes have been dashed the last couple of days. So, Tommy, take it away. The floor is yours.
Hey George, I'm always happy when I get you at least half empty is a pleasure for me with you. That's really really nice, and congratulations on launching Nope. I'm very very happy for you. I hope you do exceptionally well. I think this is a very uh, opportunity rich environment on both the long and short side. I think the bear market is going to continue for quite a while. That being said, I am in the camp that I do believe that a bounce based off of oversold indicators, internals, just about everything is pointing towards a bounce. I look at DeMark indicators, and if whoever bid up the market towards the last hour, I would have been on day 12 of 13 with the S&P and the Nasdaq. So now I'm back to day 11, and we have a couple more days to figure this one out. It doesn't necessarily have to hit a new low, but I tend to think that's possible. That being said, I am just what I tend to do is I start to buy small positions. I weight everything. Uh, in this type of environment with 2% positions, you can still make money with that. If it seems too small, uh, but you also afford yourself a little wider stop. You can sleep at night. I tend to tell people to buy top quality and upgrade the quality of your portfolio when you do have down moves like this that get to very oversold conditions. And yeah, I will say I was wrong adding some things yesterday. I thought we would get a continuation bounce. But again, I sized myself small enough to where I can add either lower or higher or cut positions and not necessarily take too big of a haircut. I think you do have to be very flexible in this market. A lot of people are the other day, 2 days ago, they were really, really hunkering with me, hitting me up saying, can we buy? Can we buy? What can we buy? And I don't watch CNBC, but I would imagine uh, that a lot of those people were also talking about what you can buy. But I think right now it's too late to hedge with the indicators and internals like this. I think you could have some further downside, and George, you and I talked about it earlier. Markets tend to crash when they're very oversold, and certainly things could get really dicey. And I've been on spaces with you for um, after this. I think the last couple of weeks, I've been saying that we were going to go lower. We had real risk of going lower, and I did believe we'd break the June lows, which we have. And I have a downside worst case scenario that I think would be somewhere just under 3,000 on the S&P, but I don't think that's going to happen on this move down. I just don't think that's possible. But like just for example, a couple of the indicators that I watch, the percentage of stocks above the 10-day and 50-day moving average and the 200-day moving average, they're at 2, 3, and 10%. That's real oversold, and not necessarily that they can't go lower. There's still a couple that can go lower, but typically, if you look at history, these things tend to get a relief bounce. And I'm not necessarily saying we're going to get this new bounce that's going to, be the bottom. I think calling any of the true bottom is a very difficult task. But I do think that you can start to look at things. Now, here's the other things that are sort of my concerns, and I've been pretty vocal with these concerns. You have a lot of geopolitical risk. Putin is getting a little unhinged, and God knows what's going to happen. He's doing a conference call tomorrow, or a news conference. So I don't know what is going to be coming out of that. I think he's going to talk about how he annexed those 4 territories in Ukraine. Um, I, I I still think he's painted himself into a corner. On top of it, I don't want to get FedExed. I did say that. I think that you got to look at companies that aren't expected to guide down versus companies that are expected to guide down. So, for example, we just had Micron report after hours. It's an absolute terrible report. They lowered guidance, they missed guidance, everything is bad. They cut capex, which might be a bit of a positive, but it's down less than 2%. And if they came out, I mean, they're already down, substantially. So you may get another quarter like we did last time where that a lot of the downside or the earnings risk gets priced in, and you could have another could have been worse type moment, or it's priced in. But I think that's the risk right now, the earnings risk. I think look at um, Apple, Tesla. I think those companies have been hiding places. I think Apple's a great company. I was short. I covered it a little early, and I'd love to be a buyer of that on some sort of substantial puke. Partly because I know that the buyback guy is going to come back after earnings and put his elbow on the buyback button and help the stock. And they certainly operate magnificently, even in downturns, but uh, only on a big pukey type thing. I think Tesla is at risk. There's been concerns going around about deliveries, that come out this weekend. I mean, Elon Musk could release the earning or the delivery numbers at 2 a.m. in Pacific Coast on Sunday morning. You never know. But I think the delivery numbers are going to be at risk. And I'm not necessarily telling people to go out and short it because this is the hardest short I've ever encountered. But it's been a demand story. And if there's cracks in the demand story and they're notable, especially when they're adding two factories, going into a recession, selling cars that haven't been updated in 5 years, that are pretty expensive, I think it's going to be a tough road for them. And it's a 900 or 800 to 900 billion dollar market cap, so it's a little insane just from that. And Ford came out with really terrible guidance. They lowered uh, their bar pretty low for the next quarter, and they were hit, I think, the hardest. They've been down in years. So I think right now it's a precarious market. There's opportunities. There's going to be bounces. Um, Trade your size small. Don't get you know crazy with options to think that you got it. But a lot of the action right now reminds me, and I wrote it today and I tweeted it out. The picture of the woman who's sitting having dinner with her husband, and she says, "Oh, did you hear the story? Russia just shot down a plane. I better do some hedging trades." Well, the market's probably limit down while she's doing these hedging trades. And I think a lot of people are thinking they're getting real smart shorting stocks here. And maybe we've got another couple hundred handles on the S&P lower, but it's not necessarily with indicators and internals and sentiment where we are right now, where I would want to be putting hedging trades on after the fact. So that's kind of where I'm at right now. And I'm trying to stay very flexible. I'm patient. I recommend everyone, if you're able to. A lot of people aren't because they're mandated to be fully invested. Try to keep cash, you know, on the sidelines. Wait for some opportunities because things are getting pretty done on the downside. And certainly, the Fed isn't pivoting, in my opinion. Hey, maybe there'll be the PCE tomorrow will be a little better on the inflation front, and maybe the market will respond positive to that. But I think the jobs number is going to stay still very, very solid. You saw claims under 200 today. I mean, that's really something that the jobs data is holding up. So I think the Fed's going to stay on it, and that's about it, George. I'm just I'm keeping an eye on things and trying to stay out of trouble.
Thanks for that, Tommy. That was quite a good summary of what's a very confusing situation, difficult situation. One point you made I'd like to reemphasize for everyone. We've talked about it before, and that is staying small. Rather than worrying about one's net exposure, in an environment like this where correlations tend to increase, it's really your gross that matters. Because the mistake that many make, and I've made it before, you have your longs that you like and you think they're good stocks, and the things you're short are bad stocks. I didn't say companies, I said stocks. But what tends to happen is in a down, if those stocks are deemed to be the good stocks or the consensus longs, you have other people puking them out for liquidity reasons, and so correlations rise. Sometimes the good stuff goes down even more than the bad stuff. So trade small if you need to trade. I just think the situation is so fraught with risk.
Yeah, and George,
Uh,
one thing also, when you start to see the loved stocks get hammered, like Apple and Tesla, and then you see the garbagey type stuff get really hit down. I mean, I'm looking at Peloton down 14%, Carvana down 20%. I mean, AMC, whatever, Bed Bath and Beyond. I'm just looking at the ones that are on the downside here on my screens. Wayfair down 9%. Uh, CarMax down. I mean, that's not a bad company, but they're in a bad place right now. I think they're really starting to show some capitulation signs. There are a lot of other people that will say, no, we haven't seen a capitulation yet. But it was pretty broad based selling today. And that that is part of capitulation. The scary part of capitulation, which many of you and I have been through, even when you're short, you're sweating and you're panicked because you're not necessarily worried about your portfolio. You're worried about a lot more in the world. And you can look back on times like, you know, long-term capital was a really panicky time and nobody knew what was going to happen. Some days when the dot-com bust hit, that was, you know, Q3 in 2000 was brutal, absolutely brutal, with so many companies guiding down and surprising the market. It was like one after another. And then the great financial crisis, you had that was prolonged. You had a lot of different episodes. You started with Bear Stearns, that got hit. Then you had Lehman. Then you had TARP. And after TARP, when the Fed came in and the government came in to bail everybody out, the market still went down. And the market actually, the NASDAQ 100 bottomed in November, but the stuff that people loved, especially in financials, they bottom months later. So bear markets can last a lot longer than people want and expect. And certainly, if we have some sort of Fed pivot, it's going to have a handle on the S&P really close to a two. And you know, if we get to 3,000, I think the Fed could start to tell everybody that they're doing their job, and that could spur some sort of bounce. So that's it. You know, we're just hold on to the guardrail.
100%. Thanks, Tommy. I'd like Dave Nicoski's up here and Kayfabe's up here. You guys can flip a coin. Who wants to go next? Kayfabe, Dave, or Dave? You want to go?
I'm fine going. That's
Go
fine.
for it. Go for it, Dave.
Yeah.
Age before beauty, David.
Oh well, I'm either way. Either way, it doesn't matter to me. But thank you. So you know, listening to some of Tommy's comments, you know, I think we were all. I think most of the majority of the market that of anyone that's been in here for quite some time, you know, and I've said it on a number of the calls. You know, the generals are always last to fall. Those are the well-loved stocks like Tesla and Apple, and until they're taken out and find a bottom, you know, the market's not done going down. You know, I've said it on another call before. You know, my range is 2,700 to 3,000 is where I think we end up. But you know what? We're all just playing a guessing game, and it seems like a logical area that we should see that last, you know, third portion of the bear market should be the biggest drop, and it should be the fastest drop. Um, you know, right now from a relative strength perspective, and I've said this on the previous calls before, you know, as I've suggested, even Hannibal Lecter said you can only live off of relatives for so long, and that's, you know, I'm referring to the relative strength is what I use to guide the market. Relative strength on, you know, so many areas of the market are just not long-term trends anymore. They're becoming much shorter. You know, if I look at a relative strength trend on Walmart's leading, but you know, you look at the stock chart and you go, you know, this is not great. It's just not going down as much as the rest of the market. And you know, I think that puts us into a quandary because historically, when you know, see a great shift in a downward, you know, or inflection in relative strength within safety, and that would be the utilities and staples, you're starting to get, you know, some bearish inflections on the relative strength. And you know, when you look back at history, you know, staples and utilities actually greatly underperformed during the inflationary years of the 70s, contrary to what many believe. And the reason why is because they have a, you know, very high fixed cost, and their variable costs are running out of control. And so those were not good areas to be in during inflation. It was usually commodities. I put up on Twitter today, you know, the GLD is outperforming the S&P for the last you know, for the last 3 months. We're hitting 3 to 4 month relative strength highs in it. But you know, you looking at the chart, you would never go, this is a chart I want to buy, because it's still in a, you know, clear absolute downtrend. So you know, when I see things like that, it just tells me that, you know, people are going into cash and sitting there, and I think that's right now the best area is sit in cash. My concerns about, the dollar here, George, you had discussed the dollar. I mean, the dollar actually closed very weak today. Obviously no one's buying free risk bonds anymore, and I use your term that you coined, George, on that free risk because until we stabilize bonds or at least get someone to buy them, I don't see that the market's gonna make a move higher, and I don't think that's helpful for the market overall. I think so many have been burned on the drawdowns within the long bonds that no one wants to touch them anymore. And bottoming processes, they take time. They take months to years. And most likely when we come out of this, there's going to be a lot fewer stocks listed in every index. I think a lot go by the wayside, just like they did after the 2000 financial crisis, where they were running on the mojo from the Fed, and I think that's running out.
So, Dave, you mentioned before about things like GLD and staples, and they're outperforming. So, on a relative basis, they're relative longs, but they're not in an absolute sense anything you'd want to own outright. Can you find much of anything in the market that on an outright absolute basis looks attractive to you?
Not outright. I was favorable of the energy shipping stocks. I mean, what's interesting is, the Fed is doing everything they can to curb demand. And, if I look at the XLE and, I'm a long-term bull on energy and, I cut out of it, when we came through the 93 level, which I've said on previous calls. The interesting thing on, looking at the XLE in terms of a relative strength basis is actually has ascending reactions, which it made its low on a relative basis versus the S&P in August, and it's moving up. And a lot of my clients are long only, so I have to find the safest place that you're still going to lose money in a bear market like this. I see that the energy still to me is the wild card, and we're doing everything to crush demand instead of increase supply. And I think that is the area that when this bear market is over, I think that's the place that's really going to take off.
Yeah, no, I share your view. I just, whether it's the big picture top-down view, which is decidedly negative, or more simply, don't think about it. Just trade what you see, not what you think. And I just go through chart after chart after chart and just cover the names up. I'm sure you go through this, Dave, yourself. It's like a Rorschach.
Yeah.
The purest way to do it is you have two piles or three piles. You have the good pile, the bad pile, and the too hard pile. And the best way to figure out whether the market's going up or down is just a summation of those observations. And I go through that exercise now. And oh my God! I mean, the scales are completely tilted in one way, and it ain't the positive way. Is that your take on things as well?
Yeah, absolute charts. Even Home Depot is near a 12-month relative strength high. But if I looked at that chart, all I can do is say, here's a support level, and it's a very small support level in terms of the long-term chart. So, you're still in a confined downtrend. You're not going to lose as much money owning it, but you're going to lose money. That's the message. It just it's not an attractive risk reward scenario.
Yeah.
All right. Yeah. Hey, one other thing, like usually when a hurricane comes over, something like, Generac, makes generators. Usually they go up. You pull up the Generac chart, you would think that, that no one's ever going to buy a generator again because it's not a solar panel. I mean, that's the type of environment we're in.
Thanks, Dave. Before we go
Yeah.
to Kayfabe, just to remind everyone, Dave Nicoski is a proprietor of Vermilion Research, does tremendous work, focuses a lot on relative strength. I suggest everyone follow him and give him a call, maybe give you a free trial. I have no commercial relationship with Dave, but does excellent work. And then he's probably one of the most underfollowed high-value guys out there, and so we got to get his Twitter following up. And I think it's definitely worth having a look at his service. And then Tommy is no stranger to this room. Tom Thornton, hedge fund telemetry, also a tremendous product. And so Tommy runs some discounted specials from time to time. So have a look at hedge fund telemetry as well. Before we go to Kayfabe, I see, and maybe Kayfabe, you can touch on this. I see we have some of our friends from across the pond with us today. Michael Howell, Shrub, Ian Harnett, just to mention three that are in the high rows that I can see. It's a very big room. We're over 1,300. So one of the things, Kayfabe, I do want to discuss, and if you don't want to discuss, that's fine, but I would like some of the folks I just mentioned, whether it's Michael Howell, Ian Harnett, or Shrub. I do want to touch on the UK. Since we had our last room on Thursday, we had an about face on the UK's position, the QE, reversing QT, going for QE, and the significance of that, and how instructive it is for the rest of the world. So, Kayfabe, I always love listening to you to speak. Everyone needs to follow Kayfabe. He writes brilliantly. Again, very understated. Kayfabe, it's always a pleasure to hear you. So have at it. Talk about whatever you want, Kayfabe.
Hey, George, thanks. Well, first, I want to echo Tommy and congratulate you on the launch of Nope. And you've set a high bar. If you annualize your alpha today, it's 500% a year, so no pressure.
That was, I mean, I'm not, the market's closed so I can talk about it. So, we started off, we were completely in cash. And I'm like, what do we do? And like, I don't want to short it in the hole. And I'm reading Tommy's stuff. Don't short it, don't short it. And so, yeah, I'm looking at the oversold indicators and I'm like, I can't stand missing a good party though. Like, the whole place is burning down. And I got cash. And so, one of my colleagues said, no, it's exactly what you said, Kayfabe. He goes, talk about you are an alpha generating machine. If you just hold cash, you beat the market by 300 basis points today. So thank you, Kayfabe, for that. So floor is yours, Kayfabe.
Yeah, so I just and I think in probability distributions. So let me preface it by that. I think things are far more ominous, including near term. I actually wrote something this morning, and I'm curious to get Tommy's input on this because he's far more of a DeMark expert than I am. But I was revisiting Jason Pearl's writing this morning, and I think there's a pretty good case for an acceleration blown 13 setup. And I'm not going to get into the weeds of DeMark, but my work tells me that, and my models and processes that I go through tell me that this is actually accelerating and scaling to longer term cycle dynamics. So when that happens, I typically look at stuff on a weekly and monthly time frame, kind of like Mr. Belkin does. Only totally different process, but it's the same kind of idea of scaling things from short to intermediate and long term as he does. And a lot of the stuff there is still very early in a cycle dynamic, meaning that obviously we haven't even cracked the June lows yet, and revisiting that kind of low is pretty normal in a bear market, that you get a 1 to 2 week kind of battle that goes on around the prior low, and that's certainly what we've had so far. I think we're about 5 days into this, so I'm a lot more worried that we won't get, and again, back to Pearl's work, my question for Tommy is we haven't even had a price flip yet on the daily time frame. And I think there was a combo 13 already, and we might have qualified our risk level off of that combo 13. So again, that's my concern, is that this is almost like an acceleration setup and like a waterfall setup. The other thing that kind of accompanies with that is the relentless amount of put selling that's going on. And I said they're maniacs. Like with expiries now 3-4 days a week. I mean, just the constant rolling of selling put premium. With what skew is doing, it's just nuts. Like there's a gamma wall laying just below the market that if it does crack, right? So the conditions are there. So I'm not saying it's going to happen. What I'm saying is the market's price is if it's still a 0.0001 probability. And I think it's exponentially higher than that. It's still not the likely outcome, but it's way, way higher than normal. And to your point on the UK, George, what happened in the UK this week is a detonation of a decade of financial repression. That's how I view it. It's the echo to what happened at AIMCO, which is a Canadian pension fund, in March of 2020 with their variance swaps. All of these institutional investors have been leveraging up because of low interest rates for a decade, And all of these structures are in the midst of blowing up, and all these dead bodies are going to start floating to the surface with this, volatility spiking, rolling across different markets. So to me, because of that, I think trying to catch counter trend bounces in this environment is very unwise. I'm not saying, get to your point, George, not saying short. Leave that to people that are crazy enough to try it. But the idea of trying to catch bounces here, I think the risk is so asymmetric. It's just really dangerous.
So, Tommy, I don't know if you want to respond to any of Kayfabe's questions or observations about the mark.
Okay, well, you're right. There's always risk of a DeMark indicator not working properly. That is something that happens, yes, in persistent trends, and it's possible that could happen again. There, not to get too technical with the DeMark, but there is the chance that the current sequential, which is on day 11 of 13, could fail, and that I think we're going to have that. We're probably going to get it next week, and then there's the risk of recycling where you get another sequential countdown. And as much as that sounds like, wait a minute, you had that happen a lot on the upside in recent years, where you would have short-lived pullbacks and then or a stall, a pause, and then the trend would continue. I think that it's possible. One of the things that I'm also looking at, and I'm a power in numbers person, is that I'm looking at within the S&P the amount of individual stocks that are hitting countdown 13s, and they're really starting to pile up. And the opposite happened last December on the sell countdowns. So you had sell signals that were persistent in December that worked out. And the other thing that's starting to occur, not necessarily on the index level, but within individual stocks, is you're starting to see weekly exhaustion signals, 13 start to trigger. And that's more of an intermediate term, which I'd say is positive. And we also had that happen back late last year. So there is the potential for, further downside. I mean, I have a couple different targets in the, 3,400 to 3,100, depending on the weekly or daily time frame, that could possibly happen. I'm weighing the evidence. I'm looking at a lot of the internals that when all these things start to migrate together, then the odds, in my opinion, for the signals working increase. But certainly, I know. I mean, just truth be told, I know that Tom DeMark has been, and his team have been looking at the recycle potential that they could continue a little lower. But I tend to look at it, and I was instructed by the DeMark people way back when I learned about it, is that all 13s matter, and you have to just respect that and see what happens after that. Um, After you get a 13, the rule of thumb is between 10 and 12 days, or bars, if it's a weekly bar or a 60-minute bar. Within that time period, you should see a price reversal. And we did have 13s back in certain times this year. We had them in June, we had them in May, some in March. So the odds of these working now, I still think they can. But if they don't work, we adjust. And one of the things about DeMark indicators is when you use these exhaustion signals, which most people don't have on their screens. I see it. I understand where an exhaustion can happen. If I mean, when you don't see it, it looks like the bottom's falling out. But when I have these signals, I can, with some confidence, do a counter trend trade. And if I'm wrong within that 10 to 12 bar period, or if a risk level breaks or something, uh, I can get out of the trade relatively unscathed most of the time.
Thanks, Tommy. Much appreciated. All right, let's keep it moving. My God, look at this room. It's just, I want to thank everyone in this room. This is just extraordinary. We decided to do this room at 3:00, and we started at 4. Just look at this room. It's unbelievable. I want to thank all of you. Okay, so we're going to the other side of the pond now. We're going to do Shrub, and then Ian Harnett, followed by Cantro. Shrub, long time. I got a couple questions. Obviously, you and I are similarly disposed. So maybe a word on the UK and also the flows data. We haven't talked about it much, but I don't know if you heard my comments earlier. Looked like the retail was giving up the ghost finally. So Shrub, good to see you. What's on your mind, my friend?
Hey, George. First of all, best of luck with the Nope. You're a great guy, and I hope you do really well with it.
Thanks
and
for that.
Thanks for all the spaces. Okay, so go back to the UK. Before we go to the UK, let's just do one quick thing. 3 months ago in the summer, you and I had a discussion where we're laughing our socks off about the US Treasury being at 3%, and we were the lone voices. If you remember that conversation,
we were laughing hysterically. We couldn't stop. Exactly.
Yeah, we're like the U.S. Treasury is at 3%, and everyone was bulled up. And I was like, well, hold on. I just gave you a long list of the buyers: China, the banks, and the pension funds, and I just proved that none of them is able to buy. So back then, we basically said China's not going to buy treasuries, the banks are not going to buy treasuries, and we had that. I kind of proved based on their results that they can't buy treasuries. And the Fed is obviously not buying treasuries because they're switching to QT. So back then it was like a completely contrarian analysis that we did, and we're just laughing about it. And there we are. So from 3%, we're now at 4%. And now we're in a very different market, because when we were, laughing and worrying about the credit market 8 months ago, we're here now. We're here now in a big way. And I still think that 95% of the people don't realize that yesterday we nearly had a Bear Stearns moment, which is ridiculous. So, I've been covering, I was mega short UK banks in 2008. So I know the UK financial system somehow. Yesterday, what happened? I figured it out from the Financial Times article. We were all kind of we couldn't believe that it was that bad. So what happened yesterday was the UK pension system, which is only like a few $1 trillion, so who cares? It's like 2 Teslas, I said. It's only 2 Teslas. So they were about to go under. So BlackRock was about to stop trading UK gilts. Not like a SPAC. They weren't going to stop trading a Chamat SPAC. They were going to stop trading UK gilts yesterday. And if you're wondering why, it's because the UK government issued 50-year bonds in February. And by last week, those 50-year bonds went from 100 cents on the dollar to 30 cents on the dollar. That's like worse than a Chamat SPAC.
Shrub. Only because I know you're being real. I almost want to ask you, have you been drinking?
I have been drinking. Yeah, I have actually, because it's 10:30. I'm super short Tesla, and I'm very happy. And it's the first drink I've had in 2 weeks, and it's been a pretty tiring month. So I'm in a merry mood about this, but I'm also quite depressed because yesterday was it gave me back glimpses of 2008, where you're kind of worried about the stability of the system. Now, that's the bearish part. The bearish part was that the system was about to blow up. And it was about to blow up because of 2 completely idiotic policymakers. Now, the positive side is that there's still some serious people in the UK, and they arrested that downside pretty quickly. But how did they do it? By doing kind of like a covert QE the moment they were saying they were going to do QT. So we basically flipped from a QT tightening to a QE and let's just plug the holes in the system. So it was a very, very bearish day, and I just couldn't believe the market was rallying on that. So I was just selling whatever I could in reality. But having said that, it gives you a glimpse of what will happen in the rest of the world. So I think the takeaway, it goes back to a conversation from 6 months ago. You cannot have the US Treasury at 3% with no buyers and the government going QT mode and bringing it up at 4%. So the UK gave a glimpse to all the QT. I think, this is just my personal opinion, I think the UK gave a glimpse to everyone who's doing QT that, guys, you can't print money, go fiscal, go loosen the fiscal side and expect that you'll be able to do QT, because I don't think anyone's going to be able to do QT. So I think the pivot that everyone's excited about, a stupid pivot, like the pivot. There's bloody idiots that talk about the pivot. They've lost like 20% of their money already, 50%, whatever. So the pivot is going to be where the QT is covertly put under the rug. And the Fed is not going to do that because the Fed is actually in a pretty sweet spot. So we're probably like, 6 to 12 months away from the Fed. But obviously, we've seen the BOV panic, we've seen the BOJ panic, we've seen the PBOC panic. So we've already seen like 4 central banks panic. So I'm only going to get constructive when I see the Fed panic. So we're starting to see the weakest actors panicking. And the bearish thing about going back to the pension fund situation, the bearish thing about it is that it's something that no one was talking about for the last few years. It's something we all took for granted that is going to be fine, and it just happened. So that reminds me again of 2008, where you had the mismatch of assets and liabilities and duration mismatches and all that stuff that blows up systems. So this is exactly what happened. And the bearish thing about it is that there's going to be so many skeletons that are going to start coming out now because the rate increases were so fast. So that's when you start seeing the skeletons coming out. Now, on the positive side, because I want to give something positive, like 6 months ago, we said that the US 10-year at 3% was the wrong risk reward. I kind of feel like the US 2-year at 4.3% is actually a great risk reward for once. So what I have done is I'm starting to park money to make like 4.3%. I'm kind of okay with that in US dollars. So I think, there are some things to do, but not much. Like, I'm like 30% invested and I'm like 30% long, 15% short. But, the US 2-year up here is actually quite a good opportunity. And I'm not going to comment about, the short-term balance is very possible. But I'm just, thinking big picture. We're basically, yesterday was an emperor has no clothes event for me, for the central banks. It was really an emperor has no clothes event. It was very scary. The fact that it was solved very quickly was a positive, but it was still scary that we were at that point. And there's more to come. And, the eventual end game will be currency devaluation. That's why everyone has to be a bit sanguine about these events.
Shrub, it's a real great explanation. What echoes with me and what I was thinking before, and you said it, it's not just the extent of the moves, it's the speed of the moves. The speed of the moves combined with the leverage. It's virtually guaranteed someone gets caught. It'd be almost inconceivable that someone doesn't get caught. And it's the speed of the moves. And, we can sit around and try to figure out who it is, but it's not important and won't be able to. As you said, no one thought it was going to be UK pensions. And so, yeah, there's going to be a lot more where this came from. And then when you think about the speed of the moves, not just in the context of who gets caught off sides from a financial perspective, but Shrub, talk dirty to me, talk bearish to me. Talk to me a little bit about the delayed response the ripple effect of the impact of rising interest rates on the real economy, like housing, auto sales. I mean, it's
Well,
sort of like, they just put the needle into the patient. It's going to take a while for that to trickle through. So, what's your view? Sort of, we talk about financial markets. That's fine, but what's your view on the economies going forward, Shrub?
I mean, on the UK side, so the UK is the most sensitive. I think I've analyzed this before, but it's worth mentioning again. So the electricity impact would have been about 10% of a UK household disposable income. So that's real money. That's why the government had to step in. So the market actually forgave the government for giving energy subsidies, and they're doing the same thing in Germany, by the way. So that's fine. But in the UK, when everyone is on a variable mortgage rate, you're talking about your mortgage going from 2% to 6%. So the impact is very significant for a UK consumer because they're on variables. So in France it's very different because they have 30-year fixed like in the US. So the consumer in France, when I did the numbers, is like, say it's 5-10% worse off. But in the UK it's 20 plus. So there you're going to have a serious impact. But it takes a while to change behavior. And I think that's why, if I was going to say one thing that people really underestimated in this whole thing, they always, the market, because it's run by young guys and, they saw the V-shaped move in 2020, they think that everything is like fast, like financial markets. But in reality, you have to think that the real economy moves slower than that. And I think where people don't realize is that we could have higher for longer, right? So why are we saying that rates are going to go to 4% and they're going to go to 2%? No, why wouldn't they just stay at 4% for 2 years? So I think that's what the central banks are trying to instill on people, just to change their behavior and bring consumption down. By the way, just anecdotally, so right now I was at the Monaco Yacht Show, so that's obviously a very glitzy event. The hotel room rates are up 3 times since last year. So obviously, the behavior of the rich is still full-on bull market, huh? And I've been told it's one of the busiest yacht shows they've had. So there's nothing like a slowdown on the top end. It's the bottom end that's going to suffer. That's why the pitchforks are going to come out. But let me just make one point that you will actually really love, because since we're on the bear porn phase of the discussion. So what I think is happening now, the moves on Tesla, Apple, all these things, it's again a discussion we've had in the past, that these generals will be used as the ATMs for the European pension funds. So imagine you're a UK pension fund and you've been buying Apple, Tesla, and all these things, and suddenly you get a margin call. What are you going to sell? You're not going to sell you're going to sell your UK stuff at the last, but you're going to get out of Apple and Tesla to get liquidity. So we're at that phase of the market. So I think what we're seeing now is a cascading liquidation by European funds. Like, Bailey Gifford is a very big shareholder of Tesla. So I think we're seeing that part, because look at the market today. The sterling was up 1.7 and the euro was up 70 bips, and Apple was down X% and Tesla was down 7%. So I think it's kind of a case of institutions selling US to repatriate to Europe. So already you're seeing this defensive moves from pension funds, which are preparing for, redemptions or whatever they're preparing for, just margin calls. So that's that on the generals. That's why I think the generals are still going to get shot badly out of this. But, yeah.
Go ahead. I was just going to say, that you and I are old enough to know they talk about the generals, General Electric, General Motors, whatever. When I hear the name Tesla mentioned in the context, same sentence as the generals, like, I want to throw up. It's like, what does the world come to? I'm sorry, but I know what you're talking about. It's just a sad commentary on what the world's come to. Shrub, I interrupted you. You were going to say something else, I think.
No. I mean, on the economy side, I think people exaggerate a bit the situation in Europe on the energy side because we haven't had the impact yet. But it will be very bad. The only difference is that the consumer is actually better subsidized and less levered than the US consumer. So, there is uncertainty, but we're not really seeing it on the street because it's kind of cushioned by the subsidies. So that's why you're seeing the currency taking all the heat. Like the UK, for example, is actually doing, pretty well. If you go to London, it's actually doing pretty well. Everything is full, but you're seeing the wealth effect. You're seeing the class divide widening. So you're basically seeing exactly all the shit that QE did, just widening. So that's why we're in this very, very bad situation in the UK specifically, because the mortgage rates going up, the electricity price going up. It's affecting the lower middle class and the middle class. So that's why you will have this social unrest building up.
Thanks for that, Shrub. Please stay there. We're always much appreciative and love your insights.
Just FYI, I have 2% battery and I'm walking home. So if I drop out, it's not my fault.
All right. If you run out, when you get back in, you can rejoin us. I'd like to stay with commentary on things UK and Europe, and one of the sharpest cookies in the room, Mr. Ian Harnett, who's graced us with his presence just the other day, was extraordinary. Listening to you, Ian, I'm glad you're back. I know the hour's getting late there, but Ian, you've been on the right side of markets, uncharacteristically bearish. And,
Thank you.
and as I've described you as being a very normal, well-balanced, pleasant human being. And when you get in a bear mood like this, it's significant. There's information content in that. So, Ian, things are happening very quickly. I believe it was last Friday we were in the room and we were talking with Michael Howe about the UK. And so maybe kind of update us on what's going on. I mean, every day it's something new. So maybe pick up where Shrub left off, starting with the UK. So Ian, the floor is yours.
So let's the comments from both Kay and Shrub were spot on. What we think we're seeing is that unwinding of 10 years of inappropriate monetary policy or overly loose monetary policy and the structures that have been built up during that time. What we've seen most recently is the pressure starting to unwind, and we're seeing who's been swimming naked and the structures that are being created that are inappropriate. Yesterday, what happened was that financial stability trumped inflation stability, George, and that's critically important. QE at a time when UK inflation is running at 10%. So, it is clear that it was the Financial Policy Committee. It was not the Monetary Policy Committee. The members who aren't on the Financial Policy Committee were informed that the decision had been taken to bail out the gilt market. This was a systemic risk event, and don't doubt that at all. So it's absolutely true. It seems as though we were in 2008. We were hours away from winding up significant institutions. And George, you mentioned the pace of this. So let me give you some numbers. That at the beginning of the year, the UK gilts market was worth about $1.9 trillion. As of close yesterday, it was $1.3 trillion. Within that, the over 15 years segment of the gilt market has lost $473 billion since the start of the year. And in the last 12 months, at the close of business before they intervened, it was down 48%.
Wait, Ian, stop. Ian, stop. If you told me Cathie Wood was down 48% or Tesla's down 48%, okay. We're talking about gilts. Or for us Americans over here, those are known as bonds. How the hell did that happen?
Well, this is the question, because not only is that on a 1 month view, you were down 28%, and on a 1 week view, just in case anybody thinks it was not about the UK budget, After the budget, you lost 19%, and in a week. And this is the real impact here, George, for everybody to recognize, is that these are your risk-free assets. You've just lost 48% in a year, 19% in a week, in a risk-free asset that since 1977, you'd only seen a loss basically once or twice beyond 5% in a week. It was 3 times the size of the monthly move that you've seen since 1977 in the last month. So the real issue here is that investors will have to re-examine what the risk-free rate is now. Bonds have been destroyed as a risk-free instrument in the United Kingdom. And that's the real challenge that is being faced. Now the problem that we've got is that whilst, as Shrub was highlighting, this was about the pension funds, they are not going to be the only people that have had this collateral destroyed. And remember, George, you've seen so many financial crises. What happens? It is always about the destruction of collateral that is at the heart of any financial crisis. So who else has been using these long-dated instruments as collateral? And of course, you're going to come back to the banks. So there's, we always said the initial phases of the next crisis would be non-bank financials, and remember that we've seen in the US, consumer lending companies are already down 60% year on year. We are now seeing the pension funds being hit, but then it will end its way into the housing markets, and then into the banks as well. And yesterday, at the close of business yesterday, the CDSs, so the credit default swaps, the risk of default in the banks in both Europe and the US were starting to rise. So the interesting question is, why do the Fed start worrying about this? Why do the Fed start intervening? Because they are worried about this spreading into the banking sector. The other implication of the Bank of England going in to stabilize at this level of inflation is that they effectively, by holding the yields down at the time when inflation is still high, they reduce the real interest rate. Real interest rate differentials drive currencies. They basically said, sterling, goodbye. We're not going to support you here. We're going to stabilize the gilt market, and we're going to take the pain in the exchange rate. So, today, the brief rally that we've had in sterling, I think that's going to be a head fake. I love the argument by Shrub. The scale of the crisis is enough that the debt management office said they're not going to sell gilts. There is the stabilization process here is really going into overdrive. They say it's going to last for 2 weeks, but it will carry on until they need it to. And there's still another $400 billion sterling's worth of over 15-year debt that I think a lot of people will be offloading quite quickly. And so I think the Bank of England could be on the hook for a big number here.
Ian, in the decades we've known each other, this is one of the most extraordinary set of circumstances I've heard you describe. And it really is numbing. And
yeah,
without making light of it, I mean, your career, I mean, seriously, this is really big stuff. Okay, and maybe the UK is a more extreme version of situation elsewhere, but what's the takeaway for you more broadly? What's the information content and what's going on as you think about the problems that exist in other countries around the globe?
Yeah,
and if we're going to continue on this path of QT at a time when maybe there'll be some more fiscal stimulus, bailouts here and there for political reasons. How does that impress upon you? How does that inform you about?
Well, the bottom line, George, is this is not a local issue. This is a global issue. I think this is the most severe systemic risk that we have had. We're seeing playing out. I think that the global systemic crisis is already started. We're seeing it work its way through smaller emerging market debt. We've now seen, some of these consumer lending companies, challenged. We've seen some of the mortgage originators in the States challenged. We've seen, so we're seeing this sequential blow up. The Danish 30-year bond is down 46% this year as well. And yet Danish banks have hardly come down. Danish insurers have hardly come down. And yet, we know that a lot of the Scandinavian mortgage market is involved there. We're going to see a lot more of these dominoes come down, would be my view. And I do think QT is to blame. Michael Howard has spent a lot of time explaining to people about the liquidity effect. We've got lots of liquidity indicators as well. But why is it that it has all been about the rise in real yields? So far this year, inflation swaps across the whole curve in America have come down. All of the rise has been in real yields. That is about a shortage of capital, which means when there isn't much of a demand for capital, that actually it's about the withdrawal of capital by central banks that's taking place here, the withdrawal of capital by various actors. So I think the QT has an important role to play here. And what we're seeing effectively today, George, is we're seeing the limits of how far real yields can rise and how much QT can be done without the financial institutional structures that have been built up over the last decade blowing apart in a very, very violent manner. So I think they're going to have to reverse on QT. And I'd agree with the previous speakers that will happen before you see any kind of pivot. And a point we've made to people, and I've put a couple of charts up on Twitter before, the Fed is only going to pivot when there's a financial crisis. When somebody big in America blows up, that's the point that you'll be seeing this issue. If you want my last tip on who is the least expected and might be the most likely, casualty here, France has built up its debt levels very aggressively in the last few years. We know Italy has a lot of debt. Very few people realize how much debt has been built up in France, and the French banks are very heavily involved in the derivatives game. So, for me, I think a risk around French financials is where I'd be looking for a big surprise that might cause the ECB to change their tack, for example.
Ian, that's chilling, but I fear a very realistic assessment of the situation. For those that don't know Ian, he's normally not like this. He's a quite pleasant, well-adjusted individual.
You keep on saying I'm well-adjusted, George. That's really scary.
Unlike yours, truly, he's not prone to hyperbole. He works for he's co-founder of Absolute Strategy in London, ASR. They have a New York office as well. And if you're interested in getting their research, you should reach out to Ian or Rob DeLuca, who's a salesperson in New York. Fabulous, Ian. Thank you for that contribution. I'm sure you have
Thanks, George. Thanks for inviting me.
I'm sure you'll have some more of their questions. I know it's a late hour, so drop off as you must, but I'm sure we'll have some more questions to follow up. Okay, I'd like now to go to Mark Newman, and then we're going to go to Javier. Mark, welcome. What's on your mind, my friend?
Hey guys, how are you? So I after hearing Ian, I wanted to just sort of take a half a step back and talk about how we got here a little bit in my view of the things. So George, when we were in Japan,
Hey, Mark, I'm sorry. I think Mark, you're driving, I think.
We always, I always talk about how
we can't
Japan had these. I'll give 2 minutes. Let me come back to 30 minutes. Give me a minute.
Yeah, okay. Yeah, come on back. That's great. Okay. Let's turn to the smartest guy in the room when it comes to energy. He's usually, we're very privileged to have him here because he's a busy guy and he snoops in and out of these rooms, but I'm glad he's up on stage. My friend Javier, good to see you.
Thank you.
Obviously, a lot's been going on in the world of energy. There's a lot of stuff behind the scenes, and so you rightfully, I'm not trying to, blow smoke up your backside, but you called it. You warned a few months ago, watch out for energy. You were consistently outspoken, concerned about what you were seeing in markets, demand waning. So maybe you could update us on what's going on in the energy market and what's top of mind from where you sit. So Javier, the floor is yours. Please unmute yourself.
Listen, first and foremost, I was very pleasantly surprised today to type nope into my Bloomberg and see a security that has some action on it today. I'm really looking forward to it, George. I sent you a note. I'm pulling for you. I know a lot of people are. Listen, there's a lot of people in this room who don't know you. Maybe their first time in here. I know a lot of people that follow me. They're simple people, right? I mean, they're ranchers and they're farmers and they are average Joes, right? And for those of you not listening, George has been outspoken for a year, and George, I remember distinctly many conversations that we've had over the last year publicly, in which after the conversation you would be either criticized or this guy doesn't know what he's talking about. He's bearish and he's macro. And George, my hat's off to you because you're gonna put your money where your mouth is. And I think it's gonna be a benefit to people to see this product you put out. I'm excited for it. I'm in, so I'm excited for it. So that's the first thing. The second thing is, like I said, I'm a simple guy, George. When I listen to the Michaels, Michael Howe, Mike Green, and Michael Foe and Ian, I listen to these guys articulate very complex financial things, and many times, when they're talking, there's a lot of people listening that are probably Googling stuff and trying to understand it. Well, I'm part of that crowd, right? I'm not that smart. I'm all effort and not real. I'm no genius. All right, and I'm listening to Shrub talk. And I'm laughing while I'm driving because everything that we're talking about here, tension, you get tension blowing up. No one had it. No one had it. No, not one person anywhere said this is going to be the first. And it reminded me when Shrub was talking that we're talking about Lake Mead right here, right? We're draining Lake Mead. And dead bodies are popping up, George. And everyone looks around and says, I didn't even know this guy was gone. I didn't know he's dead. And I'm laughing at this because this was not hard. You can't do what we did, 30 trillion into the global liquidity markets. You can't drain Lake Mead and not find boats and cars and dead bodies. It doesn't work. And so, here we are. And talking about the UK, and I said this yesterday, and this simplifies it for people. This is a simple term. The Bank of England has they have cut their hair into a mullet.
I'm saying, Javier. Hey, Tommy, can you hear Javier, or did he disappear?
I can't hear him. I can't hear him.
No.
He's gone.
He's gone. Wait for him to come back. Okay. Let's go to Bobby J. I don't know if Newman's back yet. But let's go to Bobby J.
I'm here, George, when able.
All right. So, Mark, just hold fire for a second. Bobby J, are you there? All right, Mark, you have that, and Bobby J.
Hey, thanks. So I wanted to circle back. As I was saying, I was in the middle of driving. You were right, George. When we were in Japan, when I was in Japan, always used to make a little joke about the keys to the vault of the Bank of Japan and how it was passed around between Daiwa and Sumitomo and Fuji and Sakura Bank, sort of take what you want, pass the keys. And then, as we've evolved here in the emergence of bubbles, we had the tech bubble, we had a real estate bubble, we had a credit bubble, and now we have the sovereign bubble. And that's kind of where we are now, and it's on the supranational level. And as Shrub pointed out, and I had actually Japan first, but it looks like it was the UK first. The panic button gets hit when one of the next biggest dominoes or a big domino is about to go down. And I think that's kind of where we are now. And to hear Ian talk about it, that move in the gilts, 1.9 trillion, 1.3 trillion, that's a monster move for sovereign paper. So we are at that point. And I don't want to Shrub made some amazing points that just got me thinking to sort of where the UK is trading like an emerging market almost on some level. And now we're at that point where, circling back to the U.S. market and the way things are trading here, yeah, Apple is one of the last big boys still standing. And like Shrub said, it's a source of liquidity. Got to be, because, when you look at Apple, it's still out year to date above the SPOOs by a little. I don't have my computer open in front of me. And it's still in front of the Qs by at least 1,000 basis points, I think. So you look at Amazon, Google, Microsoft, they're down as much as the Qs, maybe, more give or take. But Apple's still standing. So that's kind of where we are. And then the other thing, when they raid the House of Ill Repute, even the piano player goes to jail. There's not many places to hide. And George, you've asked this question to some smart folks here. What are you bullish on? What could you buy here? And even the chicken longs, as Mr. Belkin likes to call them, whether it's utilities or defense, they are not holding up here now. And so we're in a part of the U.S. market feeling the pressure globally, where everything not nailed down is being sold. And I want to just make one last observation. I think some people may know of my ESG position here in the orphans and whatever. They had held up very well relative to a lot of things before the last couple weeks. And now they're getting hit. And like, my only position here is I'm long that stuff and I'm short the Qs and I'm short some other things, sort of a pairs trade. And it's all sort of going down. Now my orphans might be going down a little less, but that's where we are here. And I think Kayfabe talked about it earlier. There's a lot of downside air pockets that we need to be cautious of. And Tommy talked about the sort of potential sequence 13 busts. We are at a really tightly correlated everything moment here. And I don't know, like we saw with the UK and the panic and the safety valve, how close are we for something like that everywhere else? And I think that, to me, is the big elephant in the room. And as Ian Hartnett said, it comes down to collateral. Who's got what to pay for what? And I think we really got to pay attention here, because we're at a moment where things could get hairy, and they could pull the safety chute pretty quickly. That's kind of what I'm looking for and expecting here. And the room here has been really spot on with a lot of amazingly interesting observations that everyone should just really have a deep think on. That's what I got.
Thanks for that, Mark. I mean, I want to be a little bit careful what I say, because I got a lot of grief from people. I'm too much of a perma-bear, doomster, or whatever. But I've been at this 40 years. I've seen cycles, this pattern recognition. You and I, Mark, went through the wars in Japan. And as we've said in this room many times, we discussed it earlier again, that markets only really crash from oversold conditions. And calling it crash is a fool's errand. Engenders fear, and it's a low probability event. But it's setups like this most likely when it's going to occur. And I just sit back, Mark, and I look at it, and assuming you weren't in the market, Mark, like, you're not long, you're not short, just common sense, right? You're just reading what's going on, and there's like all this, there's just so many problems popping up here and there. And unlike those who defend the market, they say, well, it's already discounted. No, it's not discounted. Markets are not discounting things. They're reacting. Putin comes out of left field, and then, whoever thought UK gilts were going to blow up, okay? Or it's just one thing after another. And if you came down from planet Mars and someone said to you, hey, you got this, that, this, and that, and then someone says to you, hey, Mark, what's the valuation like? Well, surely with all these problems, it must be giving stocks away. And then you look at it, and markets are still expensive relative to history, and liquidity, the bathtub is draining. You'd be like, you know what? I don't want any of that. I don't need that. And to me, I know this is going to sound crazy. I said it the other day, I think in one of my opening rants. I just think there's a real amount of this is complacency out there. And what I mean by that is, yeah, people are negative, but I don't think they fully comprehend what's going on here. And if they did, they'd be a lot more scared. And, even for the folks in this room who I consider to have a reasonably high investment IQ, look at all the UK news. I mean, my God. And again, going back to the speed of the move and the amount of the leverage, there's going to be a lot more where that came from. So, again, I think the risk reward is just horrible. For the average person, they should be in cash. Why you'd want to own risk assets in this type of environment is beyond me. Professionals can be short if they want to. I actually think all the alpha is going to be generated, all the absolute return is going to be generated on the short side. I mean, Mark, you've been at this 30 years. I mean, When you just think, and listen, again, I used the line the other day, Yogi Bear, please call your office. Predictions are difficult, particularly about the future. And so always weighing the weight of the evidence and considering the risk reward. But Mark, when you look, this is a question for you, Mark. When you look at this setup and you look at what's being priced in, the potential risks, and you think about this compared to past cycles you've seen, like, what occurs to you? Are you want to be involved here? I mean, I just think that the matter of the risk and the dangers just not being adequately discounted. What say you, Mark?
Yeah, I tell you, I don't go to bed short. I don't go to bed not short something. I don't want to be caught with that big ass gap down and say, oh, I just don't want to. I'd rather lose a couple points on the upside, squeezed on a position overnight, than be caught when it's down big the next day and I didn't have anything on. So I always have some sort of double levered something short on when I go to bed. That's just the way I sleep. That's the way I sleep a little better. And I want to add one thing that's a little out of left field, but it got me thinking. I listened to Doomberg's podcast recently on it was the last day or two. And he said something, and this is not immediately correlated, but just in the concept of where we are. He said, some people are wondering how we're going to survive the winter. Just think about that. We live in a modern society, and we're thinking there's like a potential ice age this winter based on the energy situation. Stick that in any sort of risk pipe you want to smoke, and tell me what you think that means when we've already seen. Just seriously, Doomberg said, we're thinking about whether people will survive this winter. That's ice age talk. And we're in modern times here. So I think that I just want to add that in there. I thought about that today, and I was like, oh my God, he just said he's wondering if people are going to have trouble in the winter. And it's not like a funny thing. It's more like a slap in the face thing. I don't know what to make of that.
So you don't have a tab in your dividend discount model to put that in your valuation. I get it. It's a problem. Oy, who asked you, Newman? All right, I want to go back to Javi. Javi, hopefully you have a better connection now. Javi, are you there?
No, yeah, I'm here, George. No, sorry, when I get those every now and then I'll get a phone call that I literally have to take and can't send voicemail. I'm sorry. Hey, so I'll just say this real quick because it's real simple, right? I mean, everybody knows where we are. Everybody has a good idea how we got here. I don't think it was impossible to call. I don't think my oil call, I don't see it as being, I try not to have hopium either way. I just try to look at data and look at fundamentals and then look at sentiment and look at path of least resistance and make calls. And I've made wrong calls. I'm not over bearish energy today. I'm looking at things that are a little different. I'm going to give you two tales of two different things that happened in the same day. And this is where we are. They are going to put, I think it's Germany that's going to put up 150 or 200 billion dollars in subsidies for energy bills today, right? And the problem with that is it's just like what Newman just said, right? What are we going to look at if it's a cold winter? When does this end, right? We're gonna backfill these holes that arguably have been created by poor policy and decades long policy and liquidity issues with more subsidies fueling more of the inflationary environment that they're in. All right, so that's poor policy. And then the second tale of that story happened at my house last night. I've got a very, very close relative of mine who is extremely deep into tech, venture, and angel investing to the point where 6 weeks ago, a relative of mine says, I'm going to raise another $100 million. And I thought to myself, are you kidding me? It's never going to happen. How are you, after what's gone on, you're not going to raise $100 million. And sitting at my dinner table last night, he gets his last $25 million on a phone call. And I'm like, now he's like, well, I'm going to make it $200 million. When both of those scenarios reverse course, I'm going to feel like the market's done its job. This is not, in a world where we're watching the things that don't matter in tech implode, when that money is so freely given after such a huge down year in Chase Coleman's of the world, when the attitude that is going to be the next move completely reverses into, I want to invest in the next company that says they can build 50 nuclear plants in 7 years, right? When that transition takes place and we see a mean reversion back to one of the main reasons we're in this problem is the lack of capex into the things that are going to drive everything he's talking about. It's a completely reverse psychology, George. And it was mind-boggling to me last night. He's like, oh, there goes 25 million. I'm like, are you kidding me? No, 25 million. I can get more. I'm going to go to 200 million. I'm like, okay. That tells me the market has not done its job, right? Here's the end anecdote of both of those stories. If we get the capitulation from our Fed and more central banks that the market's done its job, we have not structurally changed many of the issues that put us where we are today. We haven't fixed supply chains. People are like, oh, supply chains have opened up. If we reverse course, liquidity of the system, push a fake economy, which is ultimately what it is. It's an economy of things. It's not really an underbelly of industrial growth. We're back to where we were. That we have not increased spare capacity. We have not increased, they're working on LNG. We've not increased rare earth. We've not increased processing. We've not done the things that we need to do to be prepared for the next uptick. This becomes a resonant cycle. We are going to push the bounds both ways several times unless something breaks. I'm firmly entrenched in the camp, George. I think like you, that until this thing breaks, and I look, it's over my pay grade to say how it breaks or what breaks or what it is, but something's going to have to break to a point where the mentality of those two different anecdotes that happen 24 times reverse course, right? It needs to be instead of supplementing utility bills, Germany needs to be all in, 100% devoted to energy independence instead of financing their bad policies, right? And my relative, without giving up who he is, should not be able to raise $100 million in 4 days for arguably a pie in the sky companies, which are never, I don't think are going to ever see I don't say ever, but not going to see the same type of valuation metrics that he made money on for the last 10 years. That's my note today, George.
Yeah, Javier, you speak truth. You and we've never met. Someday we will. I consider we're friends because we think alike. It's not that I want to be in an echo chamber with you, but you speak truth. I've said the same thing different ways in the past. You probably heard me on one of my rants. And what I've said is blowing up these malinvestments, these SPACs, these food delivery companies with $30 billion market caps, dating apps, electric charging stations that'll never make any money. This is a good thing. This is not a bad thing. This is a good thing because this will pave the way for the healing of the system. We got to get away from this misallocation of resources. And, Javi, I can't remember if you were in the room the other day. You'll correct me on this, but I think like total domestic energy capex, if I'm not mistaken, is something on the order of, I don't know, 100 billion, 200 billion, some number like that. I'm interested here in accuracy, not precision. And I remember looking at a calculation, the amount of money put into Tesla call options last year was in the hundreds of billions or trillions. Like, what's wrong with this picture? That is the problem. So definition, we need to destroy that. People have to start to figure out that investing in the next cockamamie, dream on 30 times revenues is just not the way to go. And instead, looking at cash flows and investing in things that we need. And you're completely right, Javier. I mean, the problems that we're in are the byproduct of, years and years of underinvestment. And so I'm completely with you. And it's not that I want stuff to blow up because I'm short. I look at it more from a system perspective, and it's just a complete misallocation of resources. The malinvestment is just extraordinary. Kayfabe, you want to weigh in on this?
Yeah, can I ask Javier a question quick?
Go for it.
With the blow up with the UK and their pension funds, I think people that haven't lived through these kind of cycles, they hear about '08 and they hear of Lehman Brothers, right? And when you live through these things and you manage money through them, you remember it's like visceral. It's in your DNA. So I remember, the quant funds blowing up in August of '07. I remember SocGen. I remember Bear Stearns. I remember the Bear Stearns hedge funds blowing up in June of '07. Fannie, Freddie, auction rate securities, all these things that, Lehman, that's what the layman remembers. That's what most people remember. And the smell and the taste and the feel of an actual cycle and how it unfolds. And, you can go back the 2000 to '03 period with, the Kaz and Tyco and WorldCom. And I mean, so there's these milestones. And one of the ones that I think people were already forgetting was the commodity blow up and what happened with nickel. And Javier might know better than me, but people I've talked to have said that, there's a lot of private firms that do the commodities trading. I've heard very quietly there were insolvencies and people have been basically in workout mode because of the dead bodies that floated up that have been kept quite quiet in that blow up. So throw that into the mixer too. You know what I mean? When you start talking about a cycle and things blowing up, we've already forgotten about that one. So Javier, have you heard anything about that in regards to like workouts and that there were actually some dead bodies that should have floated to the top that didn't?
Look, the only reason I think that there are several firms that are still in existence today is that they went all in oil, or all in U.S. dollars, right? Because it was the doors closing, and if that cycle had not happened so quickly, and it's like George said, it's the velocity, right? And sometimes you can get these things correctly, but you've had record years at Glencore. Vitol blew the doors off, right? But then you have these smaller firms that are less capitalized that you don't hear much from anymore. You've had the risk tolerance in the commodities market is zero. The speculative trade is gone. What you see in the oil markets is really hand to mouth and managed money, right? You've got index money and you've got, some, CTAs, and that's really about it. You've lost speculative traders. Too expensive. They require too much capital. These companies, and you're right, they're out there. I have a pretty good idea who some of them are. I'm not going to disclose them, but they have happened. Whether they cease to exist or recapitalize, it's pretty easy to recapitalize a commodity firm that has a decent track record who got caught off sides. Pretty easy to recap in a environment like this because you still have intellectual capital that's valuable. You just have to tweak your risk metrics. So I don't think it's one of those things where it's like if oil goes, from 130 to zero that, somebody's going to find Andron, in the back of a bar. That's not that type of an event. People asking him if he's going to live tomorrow, right? I mean, it's not like that. This is one of those things where you can get a little leeway if you're caught off sides a little bit on Russia, right? That's a good story to go get recapped. So that's really my only thought on that. But Kayfabe, along with what you're talking about, and George and I talked about this months ago. 08 to now is 14 years, right? If you're managing money and you are 38 years old managing money on Wall Street, you were in business school or a junior, you were getting coffee during 08. There's not a lot of people that are deploying capital at the banks that come up through the white shoe Wall Street vertical. There's a lot of seats filled with people between the ages of 26 and 38 years old that have never been through this. Their entire training, every single ounce of their training has been bullish, right? They've never seen this. I mean, you talk about 02, 01, we've seen them, right? We've been there. I remember where I was when Lehman Brothers was announced. I remember where I was when, I saw, I know right where I was when Jeff Skilling walked down the stairs onto the trading floors and basically said it's over at Enron. I mean, we've been through these things. The question really though is, look, these spaces are a blessing. This has opened up the platform of things that people have never heard before in a manner in which they can understand. And I look down through here a lot. I'll scroll down to who's listening, and I'll look, and you'll see people that need to hear this. You'll see journalists, and you'll see people from the administration will pop in here every now and then. And this is an education. But Kayfabe, you're right. They don't know. This is fresh for people that are deploying trillions of dollars of capital, right? I mean, they are part of the mechanism that's breaking, and many of them don't understand why. That is what the pause, The pause that you have in a market like this has to be hands off the keyboard, take a step back. You know, I'm just going to give you one anecdote. The greatest trades I've ever been, my best trades. I bet we could have a space. Your greatest trades, and there'd be very few. You would talk about very few. But if we had a space with your worst trade, it would last for 48 hours with nonstop traders talking about what they did wrong. Okay, but every great trade I ever did was almost mindless. It was one where you put in your research, you have an idea, but you know, and it is all in. You're going to be in. Unless you have a crystal clear historical view of being right on those gut instincts right here, I say take a step back. Listen, learn, and watch. And you will find your opportunities to be able to make money. You don't have to be, some people have to be long. But if you have been listening to talking heads, you would have been long the entire way down. You would have lost, you've lost piles of money right now. If you had been listening carefully to the hundreds of speakers that George and others that have been talking about this for a year, you've learned something, and that includes money managers. You know, there are money managers out there that the narcissism and the hubris and I'm a Harvard MBA or whatever the story is.
So
that mentality is going to get kicked in the teeth.
Yeah. So Javier, could I ask you, as long as we got you here, because it's great you're here, just a quickie. You were rightfully cautious on energy a few months ago, seeing a lot of demand coming shortfalls. Two questions for you. A, any mark to market in terms of your views on that, given that prices have come in? And then B, this is going to really put the cat amongst the pigeons. Nord Stream 2, in terms of what happened the other day, impact, and then two, and I probably shouldn't ask this, but I'm going to. Water cooler speculation. Who did it?
All right, first one, George. This one's really simple. The market. So physical basis markets in the U.S. are firmer. We obviously have refinery outages. Gasoline is on the move. Diesel's on the move. The only thing, we've had some strong basis markets. I would not go home short oil tonight. I'm not long anything, but I wouldn't go home short oil. And that being said, this is really going to be a game of demand destruction. We've done a lot of work, a huge amount of work. Oil's down 40%, right? I mean, we've moved a lot. Time structures, time spreads are off 90%. We did not break contango. There's still demand. There are still cargoes on the water moving to China for them to meet their quotas. It's not necessarily domestic Chinese demand. They have export quotas that they have to do. So there's a firmness in the market right now. I talk about it a lot. In commodities, the path of least resistance is very important. For the path of least resistance, no matter who you've listened to, has been down, right? It has not been up. You can make any narrative you want, but if you're in the market and you see physical barrels moving, it's not been up. That has changed a little bit. Brent spreads are higher. WTI spreads are higher. Basis markets are higher. Freight is firmer. Dirty freight rates are higher. So we found a level where people are willing to buy things, and it is because of real demand. Unlike most of the tech sector, there is real demand for these things. We still have to drive. We still have to fly. We still have to eat. We if you buy a carton of eggs, you have polyethylene. These things move. So I'm looking. If the Fed pivoted today, you could not buy oil. You could not buy it. We'd be at 100 in a blink. So very cautious here. If structures keep moving, if jet prices keep moving, I might dip my toe in the water a little bit. This is the first time I've thought about I have not looked at a trade to be long in the energy sector other than in gas for months. And I'm contemplating some things I might like to do.
Well,
so that's the first thing. You asked me about Nord Stream.
Yeah, let's talk about Nord Stream. Go for it.
Nord Stream was an inoperative pipeline. Its spare capacity, its functionality was going to be political in nature. I know the world is hyped up on it. I've been asked this question 100 times in 48 hours, and the most recent time I was asked was about an hour ago before I left my office today. And I said, one, because of the nature of the last 2.5 years and the absurdity of COVID lockdowns and vaccines and this and that and market dives and what we're going through right now, like everything is on the table for absurdity. I'd like whoever did it just raise their hand, because you know what? like, and this is totally tongue in cheek. Don't start sending me DMs. But it's like at this point, like if the Canadians said we did it because we want to increase our gas supply to Europe, I would believe it. I have no clue who did it. There's probably 50 people on the planet who know exactly who did it, and we may never know. I don't know. I don't believe any headline that comes out about it. I don't care.
Okay, so Javier, forgetting about who did it, the economic significance of what's happened in material.
I don't think so. There's a lot of excess spare capacity for gas lines to get into Europe. I think, look, this is going to end up being a game of, going to be a duration game. I'll have a better answer on that in March once we get through the winter to see what this thing looks like. I am not of the camp. I'm of the camp that it's going to be expensive, but not a nuclear bomb dropping off, and Europe's going to fracture and these things. Like, I think if a mild winter and it's painful financially, but I also think it's going to do Europe good. Look, at some point in time, the citizens are going to have a regime change of the people that have made poor policy. It's going to happen one way or the other. I mean, it's the only exit strategy for Europe is probably regime change. Unelected bureaucrats making poor policy decisions can only go on as long as the population allows it. So I personally am not of the camp that it's a catastrophic event, unless we get some, record cold 8-week spell and it becomes a perfect storm. That's a whole different story. That is a horrific outcome. And Nord Stream's role in that, look, there was doubts as to whether or not that thing was going to be opened up anyway. And I'm just not an alarmist on it. I think it becomes a non-event in 18 months.
Appreciate that, Javier. Please hang around. I'm sure there'll be some follow-up questions. I'd like to go now to
George, real quick comment. Sorry.
Go for it.
I shared a chart, I think last week or the week before, of ExxonMobil and Chevron in the 73, 74 bear market when obviously there was the oil embargo and oil went parabolic. They went down 50% in that bear market, right? So I want to just say it because there's a lot of people listening. I think, and Javi, you clarify, I think you mean oil itself, right? So people can extrapolate that and go running into stocks. I just think that the risk reward in the stocks here, because again, if what we think is coming, the idea that the politicians are going to stand by and let oil companies print money and buy back shares and have CEOs get billion-dollar payouts, I think they got their heads up their butt. So, there's an asymmetric political risk in this dynamic relative to energy companies actually monetizing, even if oil does go to 200.
You know what, Kayfabe, thank you for doing that, because I need to clarify. I am not bullish energy equities at all. I mean, look, some are going to perform. You are going to have energy companies that likely do better than some index moves, but I am talking simply and purely about the commodity. So thank you, Kayfabe. I should have prefaced that.
Thanks, Kayfabe. Thanks, Javier. All right, I want to go to Michael Howell, and after Michael Howell, we're going to do Jeff Garbaz. Good evening, Michael. It's past your bedtime. It's almost 11 o'clock where you are. Welcome.
Yeah, hi, everybody. George, I haven't got a lot of time because I've got to jump onto another Spaces actually immediately. But I just wanted to say a few things. I mean, one is that I want to endorse 110% your NOPE project because I think this is going to be absolutely great. You've got so much experience of the markets, and you kind of think, I think, pretty much the same way as we all do, how to make money out of them and how to avoid, disasters like we're going through right now. Let me just say a couple of things about first how I look at the markets, and then what I think everything is saying. I started off, more than 30 years ago at Salomon Brothers. I wasn't smart enough to be a trader, so I ended up in research, and basically learned at the feet of Henry Kaufman. Henry was the doyen then of Wall Street, understood flow of funds and liquidity, and basically used to put together from the Z1 accounts from the Fed, basically a flows analysis of what was happening in US financial markets. And Henry nailed it for a long, long time. My only contribution was to say, look, the world is going global. Let's do this globally. And let's look at all central banks and look what they're doing. And that's pretty much what I've been doing for much of the last 30 years. And, we now sell this research and run money on it. here in London. The background for this year has been very simple. The policy of the US has been essentially to get the Fed balance sheet down and to get the US dollar up. And it's been as straightforward as that. The policy next year is going to be to get the balance sheet up and get the dollar down. Okay, things are breaking and there's a lot of turmoil. I emailed you, I tweeted to you, George, a couple of charts which you can distribute. One of those is looking at the degree of stress in market liquidity right now, which is back to 2008 levels. Okay, just look at the almost V-shaped rebound after the crisis in 2008 when the central banks came in. They're going to have to come in, and we're beginning to see that happening right now, with the UK being the latest. Everybody is starting to switch on to yield curve control. They'll call it something different, but that's what we've got in the long term. Okay, so essentially that's the backdrop. There'll be something breaking, but what we've got to ask ourselves now is how this ends. And it's going to end ultimately with the Federal Reserve or the People's Bank of China coming back in. The data that we look at very closely is in the second chart that I tweeted to George, which is basically Fed liquidity injections on a weekly basis and the track of the SPX, the S&P 500. It's kind of one for one. The more the Fed takes out of the markets, the more the markets go down. The Fed is slated to take out on its own calculations another $1 trillion out of markets. If it does that and succeeds, I don't think it's going to be able to do it. The S&P is going to be below 3,000. Okay, it's a straight line down move. Okay, this is real. This is extreme pain that we're going to face. The other thing to look at is what the People's Bank of China is doing. No one's been looking at China for a long time, but they've been screwed by the strong dollar, and that may have been a deliberate policy. What the Chinese have been doing in the last few days, now that the yuan has cracked, it's gone through 7.2 against the greenback. What you've got now is big liquidity injections starting in China. Okay, the first time they've done it for basically almost 2 years. September we would see the biggest inflows into their money markets. It may not be the start of something, but it may well be. We've got to watch it really closely. So I think that if you look forward, what basically is happening here is central banks are moving more and more and more towards yield curve control, which means capping yields. Okay. Now, I listened intensively to what people were saying about the UK. Most of that I just do not agree with. It's fundamentally incorrect. The UK is not in a bad fiscal situation, but the world is. Okay, the UK is not too bad. And let me just give you some indication of the situation. The problem in the UK is the leverage in the pension market and the stuff up by the Bank of England, who have had an absolutely ridiculous monetary policy for too long now. And that's what has caused the disruption in the UK. The fiscal arithmetic is not too bad. And let me tell you this, that if you look at mandatory spending by the government, in other words, entitlement spending, plus defence spending, and you take off tax revenues, you're left with a balance. That balance has got to afford interest. And in the case of the UK, prior to the budget move, that was about 180%, in other words, 1.8 times coverage. After the budget, tax reductions and energy subsidy, that went down to 1.2. So they're still covering their interest payments. Question is, what is that figure in the US now? The figure now is 0.8. So in the US, you don't cover your interest payments on the debt on that calculation, okay? And there's also discretionary spending on top. If you go forward to 2025, that ratio comes down to about 0.3, okay? So there's some big problems out there. Governments cannot afford this degree of fiscal spending and without yields going up. That's the big challenge. And what you've got is the Fed doing QT at the same time. It's absolutely bonkers. So effectively, they got about turn really quickly. And we saw the alacrity with which the Bank of England moved from QT to QE when effectively yields started to spike. Nobody could afford that. So what you're getting is this situation. What we've got to see is when the Fed moves, and the Fed will be moving, I think, within 3 months, maybe a tad more, but it's that sort of horizon. And effectively, what we've got a position for is a big rebound in risk markets sometime in 23. This is the last phase of the bear market, but it's going to be a vicious drop, in my view. So that's the view.
Michael, thanks for that. And by the way, for everyone, I put Michael's charts up in the nest. I think, Michael, the one that's maybe most interesting is the last one that you mentioned, how you were it got a lot of airtime on Twitter. You were talking about how you're looking at a big down. The last time, a big down in the next 2-3 months, followed by a big rebound next year once the QE gets turned on again. So, but in the short run, Michael, I mean, just between now and say year end, are you pretty negative on things, Michael?
Yeah, very much. I mean, I think that this bear phase normally sees at least 20% down on average, and it's fast moving. And the question is, will the central banks be able to react fast enough? They've shown the color of their money already. They don't like financial distress, and they're prepared to forget about inflation to basically to keep the show on the road. But the long-term arithmetic is the thing to think about. The perspective. QE is coming back big time, and we're living in a world where central banks are dominant, and there's no shaking away from that. That's how it is. And you look at the projections from the Congressional Budget Office. You look at what the New York Fed says about open market operations. All those publications, official publications, have the Fed balance sheet bigger than today by 2030.
Thanks for that, Michael. You're off to another space. Good luck, my friend.
Thanks so much, George. Good luck to you.
All right, so that was absolutely fantastic. So just to line up the speakers here, we're going to go to Jeff Garbaz and then Guy Sorrendillo. Good to see you, Jeff. What's up, man?
Hey, how are you?
All good. What's on your mind?
Good. So let's start with this idea of a lot of people have been talking about different periods of time, and I think it's important. I did a speech a couple of weeks ago, and it was called "Transitioning from a Bull to a Bear Back to a Bull." And so what I did was, I think this will give people a lot of context. I looked at 1980 forward, and we had to move at least 50% up. And so how big were the up moves and then the subsequent drops? So I think this is really important for people to understand. 1980 to 87, the S&P moved up, and I'm only doing the S&P, by 223%. That ended in 87 when we had the crash, and we fell by 30.17%. Then by the end of that, we bottomed at December, and then we had a run from 87 to 90, where we then went up by 56.65%, fell in 90, we fell 15%, 15.84%, and that's what I call like a partial drop. So 1987 was the complete drop, the full Monty, so to speak. And then we started a new phase in 90 to 94. We went up 58%, and then we fell in 94 by 7.75. And then came the second real big move, 94 to 2000, up by 215%. And then we fell from 2000 to 2002 by 46.35%, a complete drop. So the second complete drop since 1980, kind of going forward. And then we went up 02 to 07, 90%. And then everyone knows what happened from 07 to 09. We fell by 52%, 52.54, complete drop. And then 09 to 2020, the biggest move of all of them, the granddaddy, up 339.51%. And then we fell during the pandemic, 34% in a couple months, complete drop. And so 2020 to 22, up 114%. And so far, we've dropped 23%. So to me, it's becoming pretty obvious. Are we in a partial drop or a complete drop? And we're moving into the complete drop. And so so when you look at, you go from understanding the up moves, how much we've pulled back, and you look at the monthly DMA channel, which is what we use for our bias. And it's just a monthly moving average, 6-month moving average from the high and the low, displaced, shifted in the future by 4 months. And if we look at where we are now, and how long the duration has gone on, we've surpassed 2020, 2018, 2015, we're kind of equal to. We've surpassed 2011, and we're starting to come into the shorter ends of the 07, 09 range and the 2000 to 2002 range. So that means that we're potentially looking at a drop. We're 23 and change now. we're going to have to probably get it to 35 to 50%. So that's where we are. And then obviously short interest. Let's talk about short interest right now. People got forced to cover in June until August, and now they're starting to come back in. We had a pretty good increase this last period of time. We're almost back to a brand new absolute high on New York Stock Exchange. NASDAQ, not so much. We're still a billion shares off, but we're up from where we were a year ago this time by like 1.6 billion shares on the New York Stock Exchange and 1 billion shares on NASDAQ. So what does that mean about where we are right now at this point in time? And this year, actually, if you think about it from absolute highs to absolute lows, it's been pretty predictable. So if we just look at this year so far, the average drop, we've only had 2 drops that have been a little less than 5%. We had a 4.92 from March 2nd until March 8th. And what's important about some of these drops is they're very quick in nature, and that is what you basically get in a bear market. And then we had another one from a 2-day drop of 4.6% from 517 to 519. And now we're looking at a lot of 9% drops. And then we had 2 drops before this current one right now of 15.5 from the end of March until the middle of May. And then another one in June, which is pretty nasty. June 2nd to June 19th, we dropped 12.21%. And now we're down, call it 11.43. I gave the benefit of the doubt of a rally from 9.6 to 9.12, where we went up by 5.17. So if we look at the up moves are really quick. Like 127 to 22, we went up 6.08%. And then 223 to 32, we went up by 3.81%, 7 days. And then 512 to 517, we went up 4.04 in 5 days. And then the May 19th to the 2nd, we went up 7.08 in 15 days. And then we had this September thing, 9.6 to 9.12. We went up 5.17. So everyone should expect that we're getting like 5% counter moves in a couple days, but then we just start heading down again. And I think it's really easy for people to hop on board and try and get positive about stuff. But I mean, quite honestly, it just ain't happening. And George, you know me, I'm probably more bullish than bearish. And I don't think I've seen in a long time, back to the 07 to 09 period, like our technicals to look any worse than they possibly could.
So Jeff, just there's a lot of great information there, but I think it's a lot to absorb. So let me ask you the question in a way it would be easy to people can get the conclusion of all this. So you were citing how we're down 23 and we think we could go 35 to 50 off the highs. I remember we were up a couple months ago. You were talking about short-term bullish, but you were like mega bearish once we got past, I think it was 1st September, something like that. So right here,
August.
So right here, right now, from where we are right now, because I think a lot of numbers you threw out there, okay, it's a little bit confusing. But from right here, right now, what's your sort of outlook? I mean, where do you think the market could trade to?
We go down the next couple of weeks to 3,500, and then we kind of stop for the time being.
And you willing to look beyond that?
Yeah. I think we rally back up towards 4,000 by year end.
Yeah.
So like I'm a quarter ahead of where Michael Howe is. There's seasonality that's a positive, and now like people came in really big from the end of August until the middle of September on the short side, and now with this latest collection period, it's going to be hard not to see that number be the same or even much higher. So now the shorts are setting themselves up again, so that we could have, when we get to, I'm thinking like the 10th of October, because here's something that's kind of interesting. We've talked about this before. This pattern when the type 4s are underperforming. This will be the 3rd week in a row. So that means historically from 2009, we've got about a 50% chance of a rally next week. So not saying, I don't think it's probably next week, but then the week after it goes up to like 80%. And who knows what happens in the next 2 weeks. But the number of stocks that are up for the year, it is fallen off the face of the earth. We're down to now, coming into this month, we were at 16. Actually, last week, it was 16% of stocks were higher for the year. And I bet after this week, we're down at like 13%. So here's the takeaway. Rallies are very obvious because they're led by the weakest shit outperforming. It's just a fact. If we're going to have a rally that lasts from like the middle of June to the middle of August, that was a 2-month rally. That was led by the weakest stuff, people actually stepping in and buying. When the rally lasts 5 days, it isn't the weakest stuff that's outperforming. So yesterday, as an example, everyone was like getting excited, and I was like, because there was no separation between the stronger stocks technically and the weaker stocks technically. They had the same exact type return, and then today we just fell apart. So if you look at that, so let's say we're going to get to down 40 before all of this stuff ends, or it's down 50, or whatever the number is. You're going to have to be tactical and understand that at absolute lows, they can turn without you really realizing it until you're 3 months beyond it. And that happened in 2009. In 2009, what's really interesting, we got to 666 in March. We rallied. People didn't start covering until July, until we were well above 1,000. I would expect the same type of thing whenever we get through this. And I don't know what's going to take to get through it. I know that from one of the other research guys I work with besides Phil, he did a phenomenal graph of looking at up EPS revisions on the S&P 500. It's on my Twitter, and I mentioned it the last time. But we're down to like 240 stocks, and it bottomed in 08, 09 at like 50 stocks, and it bottomed at the pandemic low at around 50 stocks. So when we get down to only 50 stocks having EPS up revisions, then to me, that's kind of a level. Phil has always had this belief, George, you probably have heard him say it or write it, where he wants to buy stocks when the unemployment rate is high, and he wants to sell stocks when the unemployment rate is low.
Jeff, that's great. Hey, just hold the thought for a second, because a good mutual friend, I want to get him in here. He's been waiting patiently. Mr. Guy Cirandulo. So, Guy, hey, good to see you, Guy. What do you think of all the disasters that's going on out there, Guy?
Hey, George. Hi. Well, a few quick thoughts. First of all, I am so bullish, Kathy Wood, because if you invert that chart, it looks like a freaking buy.
Oh wait, so Guy, you're a big bull of SR. Is that what you're saying?
Well, to our conversation earlier today, it's just invert the charts. It look bullish. You're an idiot to be bearish. So the bottom line is there's a lot of people looking for a slight retest of the low or what have you, but the inability for a market to last more than 1 day in duration in a rally is really disastrous. So you and I worked at Fidelity for quite some time. I did 13 years there, and I kissed the ground. I walked on over there because it's beautiful, great people, and I love them all. And we've been blessed with having the ability to get research from all around the world. So our quarterly budgets were big. So the reason why I'm saying that is because we tasted at, I speak for myself, what is out there. And there's only a few people here and there that I really encapsulated their research and work. One gentleman, he left from Kansas City to Australia, McLaren, and our former colleague, Bill Copeland, got his work as well. And he made a great comment. This is back in the mid-90s. If you're less than 3 days in duration for a counter-trend rally in a let's say a bear market, it's really, really bad sign. Here we have 1 day rallies that don't last much. You're taking out the low. It just goes to show you how much selling pressure is behind the market. So I think, for me, it's, the Italian technical term is called chiudere luce, lights out. It's bad. It's really bad. So who the hell wants to buy a Microsoft down here or a Tesla or Amazon? You invert the charts, I want to buy them all day long. So, I just wanted to share that thought because I think you're doing a great job with the spaces, and God bless, and I wish you well with the ETF, and I hope to help out. But we're here to do this because we want to help people. I don't have a retail product. You've been encouraging me to get something out there, and maybe at some point. But I just don't want to see the next person lose a buck out in this market. This is really disastrous. The one observation that was really interesting today is how energy stocks like a Devon, COP, there was bidding in those stocks, and they actually, on a relative basis, were up, and some of them were actually up on an absolute. So I think that's really telling. And I think that once this crap is over, my gut is saying that this stuff could really be the leaders coming out of this. So anyway, just a few thoughts I wanted to share. And anyway, we could chat some more if you like.
Appreciate that, Guy. Thanks for that. All right, let's move on. I want to recognize first Keith, and then Keith will be followed by Nostra. Welcome, Keith. Please unmute yourself.
Yeah, hi, George. I don't think we've ever met. I'm one of these 40-year veterans who've been around for a while. I started in 1980, and maybe you're familiar with Fairhome Capital, going back a few years.
Yes, indeed.
Okay, I was the number 2 there for a decade. So, interesting. I mean, it's interesting to hear everybody's views, and I can't say I don't disagree. I've been very conservative for quite some time. My question, and maybe it's just something for a future chat, is it would be interesting to hear what people would be looking for in terms of, for example, where they expect to invest as things get worse or as conditions, appear to get closer to a bottom and there's more despair and pessimism and just giving up. It is interesting that Buffett has put, tens of billions of dollars into the energy business this year. It is kind of interesting that capital has been short in a lot of the commodity space. There's been chronic underinvestment for a long time in a lot of these areas, which I think is interesting. And yet you still have those companies that are big cash generators potentially down the road that may have some cyclicality to them. And there's a price like a Google or something like that. So I'd be interested in hearing more what people, where people expect to benefit once the dust settles.
That's fair. So I don't know if I think Guy just dropped off. Dave Nicoski, are you still there?
Yeah, I'm here.
Yeah, Dave. So you're big on relative strength, and we've talked about this before. And so even in the context of a crappy market, so I know you and I have talked about this over the years. You always look to see what exhibits the best relative strength, even as a down, as a sort of clue as to what might bring in the future. So in answering Keith's questions, like, what would you look to get long coming out of this mess?
Well, historically, the sector that you want the exposure to at the reversal is going to be, the consumer. I would expect that would be the first sector, to move again, especially with looking at a number of the stocks in there that are completely oversold. I think biotechs, I came out several months ago and suggested that, biotechs were bottoming. What's interesting is when you look at the IBB or XBI, you do have higher lows even on this pullback. So, realistically, when you look back at the small microcap names, even the junk ones, they made their low back in November of 2002. I'm sorry, in the global financial crisis, they made their low in November. And, on a relative strength basis, I think they were up about 100% versus the market before the March low. So, obviously with biotechs, you don't have the exposure to the foreign exchange. You don't have exposure to energy. So there's quite a few things in there. And I remember at that time, a lot of the names were traveling, trading below the cash value. And I think you have that right now, assuming some of these companies can come to the market in a year from now and raise capital. But I think that, looking for those areas that are not subjected to, the inflation that we're seeing, are helpful. I'm seeing a lot of insurance stocks do better, but there's a lot that are on their back. HMOs is something we recently highlighted on a relative strength basis. I've been very bullish of the energy shippers. I see the same exact playbook that you had back in '98 to 2002. Back then, you had somewhere close to 400 to 500 ships that were sold for scrap, and we ran into transportation needs. This last cycle, you saw 300 tankers were scrapped. And, I've been very bullish on, the TNKs of the world's, the front lines, Euronav. There's a number of them out there that, continue to, hit relative strength highs. Your dirty tanker index is actually near the March highs yet. So, if you want to make the argument that there's no demand out there, the index is staying high and these companies are absolutely printing money. But you don't hear anyone talking about, the tankers being scrapped and the shortage, and you're having to, transport energy by ship. So, I think that's a interesting approach. So, looking forward, I have to, as a technician, I need to look for those inflections to occur. But in tough markets like this, like I said, there's a number of stocks out there. Home Depot's near the 52-week relative strength high, but I can't look at the chart and tell you it's a great chart. It's just not breaking down with the market at this point, and I expect that it will.
Hey, George, real quick. On this topic, I had like a really actually 3 conversations this week. First time ever, people talking about early cyclicals. And look, we're in a recession now. I think the one thing that's amazing about this whole call is there's no one talking about the fact that we're in a recession. And the other day, Stanley Druckenmiller was talking about it's not going to be your garden variety type of recession potentially next year. And at the same time, you got Gunlock a week before coming out and saying he's starting to buy bonds. The trade of the year next year, quite honestly, if we're in a recession and the Fed has to pivot and has to stop raising rates and inflation starts coming down, the best return is going to be bonds. It's kind of a no-brainer. So in these discussions with 3 very smart people who you would probably know of, or you would definitely know their firms, we were looking at early cyclicals and XHB. I know housing's bad and everything, but it's definitely made a higher high. And right now it's still making a higher low. XLY as well. Home Depot actually looks really good chart wise. And granted, with what's happened in Florida, there's going to be a hell of a lot of reconstruction, but early cyclicals are probably an interest at some point in the future.
I would agree with that. And like I said, on, even Home Depot, the absolute chart though is not a great looking chart. I can say it's hitting support and it's not making a new low, but I would agree with, that's why I brought up the Generac comment earlier. You would think that with that many people without power, you would be selling generators, and Generac is, hitting new lows.
Yeah. A short research firm is attacking those guys beyond belief. Okay. And what's so interesting, George, on Generac is that the shorts typically don't get it right. So that could be an amazing play, especially if the company decides to start doing a buyback and some other things.
Right. Thanks for that, Dave. Thanks for that, Jeff.
Yeah, you're welcome.
We have a couple more speakers, and I think we're going to think about closing the room because we've been going on 2 hours and 20 minutes. So everyone keeps saying keep these rooms shorter, but the rooms are so good, the quality of the conversations and the speakers. So I want to go to Nostra and then Carpathia. Please unmute yourself, Nostra.
Hi, George. Thank you for letting me speak. I'm just curious how many people here take into account tail risks in talking about the escalation in Ukraine and Russia. I know it's hard to do geopolitics when you're managing a portfolio, but when you have a tail risk similar to Brexit or Trump, it makes a substantial difference. I'm just curious what everybody thinks. Thank you.
So I'll speak for myself. It's top of mind for me. I think particularly in an environment like this where there's so many moving parts, how's the saying goes? Nobody knows nothing. There's so many ways to lose. We've seen so many things happen that were unexpected. To think that there won't be more of that is foolhardy, in my opinion. And importantly, these types of considerations contribute to lower valuations, lower PE ratios, not higher. I think, especially if you've been in the room from the beginning. I mean, you asked about the Ukraine. I don't want to open up that Pandora's box. I will just say, though, we have a couple of very smart fellows in the room. I'm not sure who they're today, but friends of the room, military guys. Schmuckatelli, if he's here, please raise his hand, or L'Enfant. And they gave us insights going back already to February in the run-up to the invasion, when the consensus was that there would be no invasion. And they pointed out to the contrary that there would, and they explained why, and they were right. And they were just in here recently, at least Schmuckatelli was. He has the best name. I'm not making that up for those who don't know him. Sergeant Joe Schmuckatelli. It's not his real name in real life, but that's his stage name in Twitter. He's got the coolest stage name out there. We asked him this question last week, and couldn't really answer that specifically, but what he did say was this is not going to go anytime soon. It's going to be longer rather than shorter. And furthermore, said that you cannot judge Putin on the norms that you would expect of most people. That he will do things that go beyond what's considered normal or acceptable behavior, and so anything's possible. I do not pretend to have any insights as to what he's going to do. I don't think anyone really can. There's only one person who knows what he's going to do, and that's him. And I also think that he's one sharp cookie. He's a cruel, odious criminal in terms of what he does, is willing to do to people. But I think he's capable of anything. And so we can't be precise. I mean, you ask us a deceptively complicated question. It sounds simple, but it's hard to answer. And I just think the range of possibilities is so enormous. It's so hard to handicap what he's likely to do that you should be in this situation eyes wide open. So it's certainly top of mind for me. Thank you for that question, Nasra.
If I could add to that, so if you were to play that situation, you would go long oil and wheat?
No, because as Javier has been speaking, Javier, who I take my cue from, he is the smartest guy when it comes to energy. And energy is complicated. There are a lot of cross currents here. I mean, yeah, by itself, if we get some fireworks erupting further again, yes, that would be positive for the oil price. But at the same time, we're looking at a recession, and energy stocks, not high, but energy stocks, going to do poorly in an economic downturn. So I would be loath to base an investment in energy or agriculture simply on what Putin may or may not do, because there are a lot of other variables out there that will determine how that plays. So again, I thank you for the question. I'd like to move now to Carpathia. Good to see you, my friend. Please unmute yourself. What's up?
Good. Congratulations, George. Fantastic room. To Gnostic, I mean, tail risk, just keep your cash. It's already been talked. Keep your cash high and your size small. And then I want to talk to Keith, the former Fairhome. I mean, I own the fund. I just don't worry about it. And then your clue in all of this, you ask where we're going to go. I do macro, I do deep value, I do growth momentum. I'm like a jack. I have ADD. But we know there's going to be the tide going out. So in the Fairhome bent, for people listening, if you haven't heard of that fund, look it up. If you haven't heard of Horizon Kinetics, if you haven't heard of George, nope, look it up. Other value houses, and you got to know what you're looking for. And I agree with Dave. I think the energy sector I took it way down. I'm not going to mention any names. Garbaz is going to hate this. I'm really looking at the metals, the miners, with the proper balance sheet, with the right CEOs. Some of these things are below net asset. They're paying down debt with the right CEOs, and we're looking for this inflection point, right? I am in the house. I'm the resident gold bull. I'm looking for that moment where they are going to support the sovereign, and we'll get our clues. We'll get our clues like Devin. Somebody mentioned Devin. There's a clue today. I think I DM'd you, George, a couple of days ago. We're getting clue days now. They're not actionable, but if you know what you own and you can buy a dollar bill for 50 cents, you close your eyes. It'll be the hardest freaking trade. Walter Deemer, if you're not on here, I keep your book taped to my screens. When it's time to buy, you won't want to. And that's where I'm looking. I'm looking at the precious metals. I'm looking at the energy. And somebody mentioned it earlier. Had dinner with a guy who has a chemical company last night. He's killing it. The margins are there. The companies that are going to be actually producing cash flow. I like the bonds, Jeff, too. I mean, I'm not there yet, but this is where you're going to make your money. You make your money in the bear markets. You just don't know it, and it doesn't feel like it. But that's where you make your money. And in that, it's going to be stressful. It's going to be scary. Rooms like this will help. It's great to listen to you guys, but I'll end with one totally non-market commentary just to help us get through this. This is what we do. It's not who we are. We do it because it's a profession. It's not who we are. Your life, your family, and stuff. So anyway, thank you so much, guys. I'd look for the precious metals at the right time.
Hey, Carpathia, well said. Always appreciate your wisdom. And I think rather than focus on one particular sector or stock that Carpathia mentioned, I think the bigger message for that he's articulating, and I totally agree with it, there are going to be winners and losers. This is going to become an environment for active managers. So whereas the last number of years, I'd say certainly up till a year ago, it was all about indexation and FANG stocks and whatever. I mean, passive kick the daylights out of active. I think an environment like this, you have economic volatility, it's going to present winners and losers, and I think you're going to be richly rewarded for doing your homework. So thank you for that, Carpathia. Jeff, did you want to say something?
Yeah. So just tell, or he's on so he can hear it. But I'm actually getting closer to wanting to be positive on the materials because of the technical action of what I call the bottom fisher coming into play. And yesterday was a pretty amazing day in terms of what the materials did. Obviously today it kind of took it back, but I'm closer to thinking about them as long ideas than I am as short ideas at this point. So there you go.
Thanks,
Bingo.
Jeff. All right, we have two more speakers, and then we're gonna close the room. I want to go to Meta, and then Illinois. Meta, please unmute yourself. Indy 85. Indy 85, are you there? Okay, hearing none. Illinois, good to see you. What's going on?
Hey, George, thanks for having me. Greetings from the Canadian oil mafia. While I have you guys here, I just sort of wanted to ask, we saw Canadian Natural Resources, their ticker symbol is CNQ, sell off 8% on Friday, sell off another 8% on Monday. Volumes were a little bit elevated, but not, way out of whack. I wanted to ask some of the chartists, is this capitulation? Number one. And number two, how do you think about, the downdraft that might be coming, from other either NASDAQ or S&P related stocks washing over to energy? Does anybody have any thoughts on that? Thank you.
So I'll let's have Dave Nicoski and then Jeff. Just your take on energy.
Well, I mean, I'm looking at the CNQ chart. I mean, you're at a support level, but with this market, I'm not eliciting anyone to buy anything at a support level here because I do think that we move lower. It's not a chart that I would go out and buy. I need to see some type of reversal pattern. Is there capitulation? Yeah, volume certainly picked up, but until that dissipates or reverses back up, I would like it to see it close the gap. But the gap is, back up at 52, and it's sitting at 46.73. So it's a risk reward scenario where if you bought it here and it can't close that gap, that's not going to be a good thing.
Hey,
Jeff?
George.
Yeah, Jeff.
Blue Horseshoe loves CNQ. And I'll tell you why. It's massively.
Wait, Jeff, hold on. For those of us that don't know Blue Horseshoe, what is that? Sorry.
That is from Wall Street. And Bud
right.
Blue Horseshoe.
Yeah, okay, got it. Yeah, okay, go on. Yeah.
Blue Horseshoe then loved Anaconda Steel. now it's Canadian National. So here's what's so interesting about it. It's heavily shorted. It's 21 days to cover. So it's going to take the shorts forever to get out of this thing. And historically, the shorts have made money on it. So you probably think, well, there's no way Jeff's going to like it. But it's down 15%. And historically, the shorts only make like 6%. So it's kind of outstayed its welcome. And the times that the shorts got squeezed on it, they got squeezed 35%. So if I take down 15 to get back to even and then another 35, it could be a 50% mover. And I think one thing that people don't understand about this market, George, you probably understand it better than anyone, and you're going to understand it even more. There's no liquidity in this market. And so what is a short ratio? It means how long it takes the shorts to cover. But that's if they're the only ones that are buying. When they have to compete against other people that are long, this thing really has a short ratio of like 35 or 40 days to cover, not 21 days. So I think this could be a fabulously interesting name for next year. And I think everyone's going to start thinking about what do they own next year when, 85% of all stocks are lower for the year.
Yeah.
Yes, thank you. I think you just made some new friends in the Canadian oil investors.
There you go.
I think below 45 is just a place I wouldn't touch it. The one thing that it does have, just be aware of, it does have a head and shoulders top on it, and if that's any conclusive, whether you believe in it or not is not the scenario. But if it does take out 45, it's definitely going to secure that head and shoulders top pattern. Now, I always tell everyone that the failure of a bearish pattern is extremely bullish. Okay. Because it means other investors that do utilize these pattern recognition, they're going to have to reverse course if this thing moves back up. You see what I'm saying? So it's sitting right on the precipice of a head and shoulders top neckline.
Yeah, and it's just as an FYI, it's also got an inverse Prussian helmet formation that's being tested right now. So it's
you're right. Yeah.
All right,
so
guys. I think that's we're gonna call it. All right. So listen, this has been a fantastic room. Again, we've had from the top, from Shrub to Tommy Thornton to Michael Howell to Ian Harnett to Jeff Carbaz to Javier Nicoski. I mean, I missed so many people. It's just extraordinary. Thank each and every one of you. And these are really, really, I appreciate all of you. I mean, I learn a lot from these rooms. It's a real privilege. It's a pleasure. We really got a nice community going here, and these are not easy times. And I think we band together, and no one's got a monopoly on the truth, and try to keep each other out of trouble. So this is great. We'll do it again before too long. Again, it's funny. I mentioned earlier how people tell me I got to keep the rooms to an hour and a half, 2 hours, and I get these direct messages. Don't you dare do that. These rooms are great. We can't get enough. So whatever. I can't win. All right. So listen, I want to thank all of you. This has been great. Stay safe. See you again in a few days. Take care, everyone. Good night.